This is Barry Knapp with Ironsides Macroeconomics. It's Sunday evening, October 22nd, 5:45 Colorado time. Shockingly, the Broncos just won a game. I'm not a Broncos fan, Patriots game, but this year that's shocking too. The note this week was titled Demonetization. We're getting this out on Sunday night ahead of a flight to New York City tomorrow morning for the Robinhood Investors Conference. It should be an amazing conference. There's quite a number of good speakers, but highlighted by Stan Druckenmiller, Paul Tudor Jones, of course, who was one of the key founders of the Robinhood Foundation, Izzy Englander, Ken Griffin, Stevie Cohen will all be speaking at the conference or hosting other speakers at the conference. So it should be quite good. This audio summary of our weekly podcast is going out to, the full one is going out to everyone this week, including the free subscribers. This would be a good time to ask us for a trial subscription. Next week's note, although it's essentially Chatham House rules, so I won't be attributing any of the thoughts that I hear to any one particular individual. Should sharpen up my ideas quite a bit, but not that we haven't been on track recently. We've obviously been quite negative since the last Fed meeting, and we viewed this as their third communication blunder of the process, or perhaps they don't view it as a blunder, but we surely do. And we reset our objectives for the S&P to go back to 4,200 after that last Fed meeting. Eliminated our base case of rallying back to the July high or even getting all the way to 4,800 by the end of the year, based on what we consider to be overly hawkish Fed forward guidance, and expected that there was a pretty good chance that the 10-year part of the curve would get to 5%, which sure enough we did last week. Tried to bounce off that a little bit, but we really haven't had very sustainable bounces thus far. As I'm recording this, S&Ps are up 10 handles. It's not surprising they've bounced on Mondays a couple weeks in a row, but don't really think that rebound is sustainable. And as S&Ps try to bounce, 10-year note futures are down 5 plus 30 seconds or so. So this week's note had 4 basic sections to it. A section on debt monetization and the role of QE over the last 15 years or so. And now the Feds hope to get out of the debt monetization business, but we don't think they'll be able to. We then talked about pandemic data distortion and how it may be flattering the retail sales numbers. We then went on to discuss whether the Fed's balance sheet is still adding accommodations. I think our approach to the thinking that there's 3 primary channels for the Fed's balance sheet to impact markets is a little bit unique. And so we wanted to give a bit of an update on that, just how the QT process is going, and then wrapped it all up with some final thoughts on the market. So first on the debt monetization, or demonetization, as the Fed would like it to proceed. We began by providing some historical perspective, how initially QE during the global financial crisis was a way for banks to try and delever. Banks were unwilling to do that until the stress tests and the government essentially said the capital structure, the credit part of the capital structure, is money good for the top 19 banks. That allowed them to sell equity, recapitalize, and move on. To that point, it made no sense to be selling their treasuries or mortgage-backed securities. That was the most liquid part of their balance sheet. That would have only left their balance sheets less liquid. Having had a front row seat at Lehman Brothers, I can give you firsthand knowledge that that's how big banks were approaching this at that time. But of course, QE, which was meant to essentially be the Fed's lender of last resort function, quickly morphed into a way to manage the economy. And QE2, Operation Twist, reinvestment of mortgage-backed securities into more mortgage-backed securities, and then QE3, was essentially the same as what happened during the pandemic, where the dash for cash forced the Fed to buy unlimited quantities of treasuries and mortgage-backed securities. But then that seamlessly evolved into buying, 80 billion of treasuries a month and 40 billion of mortgages a month, and unlimited reinvestment of those securities. And that, of course, caused just an absolute boom in housing. The Case-Shiller Composite Index went up 46%. And all this essentially was debt monetization. We described it as the mother's milk of modern monetary theory, which led to what started again as a way to help facilitate deleveraging of household balance sheets, deleveraging of the banking system. But essentially, all that debt wound up on the government balance sheet. And while some will look at the current situation and say, well, government spending is not quite as large a percent of GDP as it was during the depths of the pandemic. Of course, that was crazy amounts of stimulus. But even so, we're left with that debt. And private sector debt in the financial sector or in the household is deflationary, but government debt is inflationary. The government ultimately has no recourse other than to try and inflate their way out of it. This is something we referenced a paper a few weeks ago and talked about how unexpected inflation played a pretty big role in winding down the World War II debt. And once again, we have this excessive government debt. And so there is no way for the Fed to get out of debt monetization. They right now may be thinking, gee, we don't want to facilitate any more government spending, but they're not even really willing to talk about it. So we see no way out for the Fed. And this will be an inflationary impulse through this business cycle, in our view. We then discussed the political economy a little bit, the parallels between LBJ's Great Society, all that excessive spending that really did kick off the great inflation, and President Biden's current situation. There was some very interesting polling last week. We showed a University of Michigan sentiment by political party and showed that how all the sentiment is so negative on the Republican side. It's negative for independents. That's typically when the party in power loses, is when the other party is more upset. And so we are setting up for that kind of a scenario. We also had a Bloomberg morning consult poll last week that was, 7 swing states. Trump was beating Biden by 4 points, but on single issue polling, which we don't put a huge amount of credence on, but still on those single issues, the economy, even infrastructure, which Trump never passed anything on and Biden did, the public Republicans, independents in particular, trust Trump more than they do Biden. So we think there's a pretty good chance that Biden will end up pulling himself out of the race like LBJ did, and Trump could easily get pushed out of the race as well. But we're absolutely convinced that this debt and deficits issue is going to rise to the top of the public's concerns and be one of the very most important issues in the election in 2024. And neither of the two leading candidates has a good story to tell on that subject. So moving on from there to the pandemic data distortion, we showed retail sales on both a seasonally adjusted basis and an unseasonally adjusted basis in the report this week, just to show you how volatile those retail sales are. They spike around Christmas, then come off sharply. September, they typically come down after back to school selling season is done. But we think that pandemic polluted that seasonal adjustment factor, and such that the really strong numbers in September and most likely in August are probably not the true underlying trend. There's so much anecdotal evidence out there, including the Beige Book last week, that says that consumption's actually softening quite a bit. Remember, that only represents 20% of total personal consumption expenditures. Services are 2/3. The government doesn't have a clue what services spending looks like till they get their flash estimate of the quarterly services survey 50 days after the end of the quarter. So well after this advanced estimate of GDP that we're going to get this week. So that's why services spending ends up getting revised so much in these reports. We don't think the economy is nearly as strong as the flash estimate of GDP is going to indicate on Thursday. So that's it on that. Moving on to the Fed's balance sheet. Again, we believe there's three primary channels. There's the liquidity bank reserves channel. There's longer duration real rates, the duration effect, and then there's the volatility effect. And so we walked through in the note those three various channels, and we think, although under our liquidity construct, which is total Fed assets owned outright, less the Treasury general account, and less the RRP programs, not just the RRP, but also sponsored repo, which is not nearly as big, but still not insignificant. The rest of the liquidity is available to the private sector, except right now we think banks are hoarding reserves, in a little bit of a repeat of what they did in 1937-38 when Mariner Eccles thought that they could drain reserves out of the system because it was an inflationary risk and they caused a recession within a depression. We think banks are hoarding reserves right now as well. They're worried about their multifamily real estate risks. They're worried about rising credit costs. And the inverted curve just makes it such that banks have no alternative but to shrink. And that was the main message out of bank earnings, this regional bank earnings last week, is that the outlooks were really downbeat. And that's why the stocks sold off in our view. So we don't think the liquidity channel is particularly accommodative right now. We've heard some commentators on TV, people that do similar things to us, saying, oh, the Fed's balance sheet's still offering accommodation. We don't think it's really offering much in the way of liquidity, despite that reserves being at 3.1 trillion, because we think banks are hoarding them. Now, moving on to real rates, obviously there's this big debate about term premium and the models and whether those models are valid or not. Term premiums moved up a lot, but it's still historically low. However, real rates, if you consider where the 10-year real rate median level was from 2002 through 2008, pre-global financial crisis, pre-QE, the median level was 209 basis points. We're at almost 250 right now. So on that basis alone, the real rate channel doesn't look particularly accommodative right now. It looks rather tight. And we think the term premium arguments are kind of weak because they're theoretical models. That would indicate that there's still some accommodation from the Fed's balance sheet, but it appears that government supply is offsetting the fact that the Fed holds, a little less than a third of total treasuries outstanding because of expectations that number outstanding is just going to keep going up. And then finally on the volatility channel, the move index, which is short-term gamma, is 130 basis points. It averaged 100 in the 2000s, so that's a bit elevated. Longer-term vol would probably be higher if the Fed didn't own as many mortgage-backed securities, and the vast percentage of the mortgage-backed securities market wasn't, in essence, out of the money, meaning most people hold 30-year fixed-rate mortgages at much lower levels, so there's not that much convexity in the market. And the housing market is weakening decidedly. So, new purchase applications are at, multi-decade lows. So we're just not getting that volatility impulse. So volatility could be higher, but it is historically reasonably high. Real rates are reasonably high, and we think there's reserve hoarding going on. So we do not think the Fed's balance sheet is providing accommodation right now. So final thoughts. We set 4,200 as a target. After that last Fed meeting, we're pretty much there. We set 5% as something of a target on 10s. We're pretty much there. We thought, we'd get through 2% on 10-year real rates. We're at almost 2.5%. Still, though, the market to us does not look like it's a fat pitch yet. If you just think tactically between now and the Fed meeting, and I don't know this is short term, and there's lots of you out there with longer term time horizons, and you should have longer term time horizons, but consider the data the Fed's going to get between now and the Fed meeting. GDP will be strong. PCED consensus forecast right now is for a 0.3% core, and employment cost index, I think the headline expectation is for 1% or so. We do think wages are, with what we think is going on in productivity, we think wages are sustainable, and the Fed may conclude something similar. But there's not enough in that data to get the Fed to change their narrative between now and the meeting, Powell's press conference. The only thing that can do that is a financial crisis. And that tail risk is getting fatter. In a lot of ways, the market is acting similarly to what it did prior to the crash of 87. We wrote a report in January of 2018 at Guggenheim called Echoes of 87. It was the same idea. You get this move in rates. Equity investors console themselves by saying it's being driven by growth. We can't look at Bloomberg or look at a story without somebody repeating that same story. Yeah, this is all about stronger growth. It's not really. It's a little, that is affecting the Fed's reaction function to an extent. But this is really about supply and the Fed losing their best, or the Treasury, losing their best customers for that supply. Asian central banks because of the change in the correlation of the dollar, banking system because of the deeply inverted yield curve, which is less inverted now, but is leaving a real mark as it disinverts by a bear steepening and causes massive losses in bank portfolios. Remember, a third of their holdings are securities. And then, of course, the Fed's no longer buying. And so there is a chance that the market could be decidedly lower between now and the Fed meeting. The Fed ultimately is not going to hike again, we don't believe, but we need some confirmation of that and some visibility into cuts in the first half of 2024, which we think are absolutely necessary for the market to be able to absorb the Treasury supply, the multifamily real estate supply, office supply, high yield supply. We're going to get hit with a tsunami, and with a deeply inverted curve and wounded banking system, it's not going to be a pretty sight in 2024 unless the Fed decides to change their story. We think they will, but we could have some more pain before we get there. So that's it for me this week. Again, off to New York, and should be looking forward to next week's node. Hopefully it'll have lots of cool insights to it. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.